Hello everyone, welcome to FinTalks. Inflation, increase in prices of goods, decrease in the value of currency. No country is exceptional. All countries around the world are facing the issue of rising inflation day by day. Who can control this inflation? How they can control? Controlling inflation is in the hands of central bank of a country. A country's central bank can control the inflation. All central banks around the world, global central banks, taking aggressive measures to control the continuous rising inflation that was obstructing the market expansion. How they can control the inflation? A central bank of a country can control the inflation by increasing interest rates. Recently, US Federal Reserve increased interest rates by 75 basis point in an effort to combat high inflation that was beaten the global financial markets. The Reserve Bank of India also increases interest rates by 50 basis point in response to increase in inflation and decrease in value of rupee. How this increase in interest rates will control the inflation? What is the connection between these two? Simple. Whenever RBI, whenever central bank of a country increase interest rates, all other banks in the country automatically passes these higher cost to their customers and companies. As a result, the customers and businesses have to pay more for borrowing. The public people will feel that borrowing is expensive and costly. When the public feels that borrowing is costly and expensive, they start spending less. When their spending decreases, it leads to decrease in demand, eventually to decrease in cost of goods. The relationship between inflation and interest rates is inverse, opposite. The inflation increases when interest rates are low, the inflation decreases when interest rates are high. The government policies to increase interest rates will reduce the inflation and will bring the economy back to its price stability portion. If this information is useful for you, please subscribe and share. Thank you. Have a good day.